In the past, owning a home was a key part of the American dream, but now it's turning into a nightmare for lots of people. Why? Well, it looks like a housing collapse is on the horizon, and it's hitting hard. According to a report from TR Union, a credit analytics firm, the average American household is having a tough time dealing with nearly 8% mortgage rates. This is leading to a situation where many are at risk of losing their homes because they owe more on their mortgages than their properties are worth. Adding to the challenges, potential homebuyers are finding it tough to enter the market, and sellers are feeling the pressure to cut prices to make a sale before 2023 wraps up. The impact is hitting major cities especially hard, with some already experiencing significant drops in property values. In the third quarter alone, San Francisco witnessed a notable 15% decrease in home prices. Meanwhile, Seattle and Austin weren't far behind, reporting respective drops of 12% and 11%. These are clear warning signs of a housing crisis unfolding. If you're new to our channel, welcome. Today, we're diving deep into the latest data on the real estate market meltdown. And to our regular viewers, a big thank you for your ongoing support. We've got a lot to cover, so brace yourself for the updates ahead. Recent weeks have brought troubling signs to the forefront of the U.S. housing market, raising concerns among experts about the path ahead. Reports from Fortune suggest that the market is showing signs of stress, and Wells Fargo economists are even predicting a real estate recession due to the surge in mortgage rates. As of today, the 30-year fixed mortgage interest rate has climbed to 7.74%. This sudden increase in borrowing costs has had a significant impact, causing the volume of mortgage applications to plummet in recent months. This drop signals a sharp decline in the demand for housing loans at the moment. Redfin also reports that the spike in rates is putting pressure on home sellers, compelling them to reduce prices to compensate for the additional expenses buyers face in their monthly mortgage payments. In simpler terms, the combination of high home prices and increased interest payments has put buying a new home out of reach for many Americans. This is forcing sellers to reduce their listing prices. According to Redfin's latest housing market update, around 1 in 15 homes in the U.S. on the market have seen a decrease in price in the past quarter compared to previous years, a worryingly high rate. Adding to the grim scenario, a report from real estate data firm Black Knight reveals that over 1 in 10 homes purchased in the last year are now valued lower than the amount their owners owe on their mortgages. This troubling trend has been on the rise since the beginning of 2023, reaching a point where 11% of those who bought homes in 2022 are now dealing with properties worth less than their outstanding mortgage balances. Adding to the concern, over 25% of buyers who acquired homes in the first 11 months of 2023 find themselves in a precarious situation. Their properties are now valued less than the loans they took, putting them underwater on their mortgages and at risk of foreclosure. This is a deeply troubling trend that raises significant alarm bells. The situation is likely to worsen as delinquency rates continue to rise. When a mortgage payment is overdue by more than 90 days, the looming threat of foreclosure becomes a stark reality. There's a genuine fear that hundreds of thousands of Americans could be directly impacted by foreclosure in the coming months. As we approach December, there's a concerning uptick in the number of borrowers who are 30 days behind on their mortgages, showing a 15% year-over-year increase. This surge is pointing towards a potential wave of foreclosures looming over the winter months. Disturbingly, delinquencies are on the rise at all stages, early, mid, and late, and across various loan types. According to Joe Melman, the Senior Vice President and Mortgage Business Lender at TransUnion, overall delinquencies worsened in 36 states and the District of Columbia. This distressing trend, now continuing for the 8th consecutive quarter according to Black Knight and TransUnion's Credit Industry Insights report, is only adding more pressure to an already strained housing market. Matthew Graham, the chief operating officer at Mortgage News Daily, didn't mince words during a recent CNBC interview, describing the situation as painful and ugly. He went on to express a sentiment shared by many in the mortgage industry, stating that in many aspects, this scenario appears worse than the great financial crisis in terms of volume and activity. The impact of surging mortgage rates is hitting American households hard, as emphasized by experts. A staggering 93% of those who bought a home this year express regret over their decision, according to a revealing survey by Clever Real Estate, shedding light on the current state of the housing market. The sentiment among recent home buyers is telling, with 53% stating that it's not a good time to buy, and a significant 66% finding the home buying process more stressful than anticipated. Adding to the disillusionment, over half, 52% of homebuyers feel that the stress of purchasing a home in the current market hasn't paid off. Surprisingly, 20% report being less happy as homeowners than they were before making their purchase. This paints a grim picture of the challenges and dissatisfaction faced by those navigating the real estate landscape in recent times. The source of their frustration? Unforeseen costs. A significant 26% of recent homebuyers encountered unexpected expenses, while a striking 56% believe that their home purchase has placed them in a financial situation that surpasses their ability to manage. Furthermore, 1 out of every 4 homebuyers indicates that their overall financial status has taken a hit, sometimes quite significantly, since becoming homeowners. The struggle to meet mortgage payments is pushing millions of homebuyers to the brink, with a noteworthy 62% acknowledging difficulties in making their monthly payments on time. This highlights the severity of the crisis in the current economic climate. The survey findings also unveiled that approximately 38% of mortgage holders in the U.S. are facing the reality of making cuts elsewhere in their budgets if mortgage payments continue to rise. Alarmingly, 7%, equivalent to around 11 million households, expressed that they would be compelled to sell their homes if costs keep escalating. What's more, the data reveals that 23% of homeowners feel a significant impact from their mortgage payments on their daily financial decisions, influencing choices related to everyday purchases and savings. Mark Patton, vice president at research firm Opinium, commented on the situation, stating, "As day-to-day living expenses continue to climb, American mortgage holders find themselves dealing with an uncertain financial landscape. This underscores the challenges faced by homeowners navigating the current economic climate. Despite the Federal Reserve keeping interest rates steady in the latest meeting, the cautionary note was clear. The Fed's efforts to curb inflation still have a long way to go, implying that prices may not see a decrease anytime soon. This poses a significant challenge for homeowners, many of whom have locked in low fixed-rate deals by today's standards, finding themselves in a financially precarious situation. Simultaneously, these elevated rates are dissuading potential homebuyers from entering the market. For instance, someone who purchased a $400,000 home in October 2021 at a 3.09% interest rate would be paying $1,621 per month on their mortgage, assuming a 5% down payment. However, with today's rates, that same homeowner would be forced to shell out $2,657, a substantial increase of over $1,000 per month. This highlights the considerable financial strain placed on both existing homeowners and those contemplating entering the housing market. Describing the current real estate scenario, Sam He, chief economist at CoreLogic, labels it as a baited market. A market divided between those with opportunities and those without, witnessing a sharp drop in demand. Existing home sales have plummeted by over 15%, reaching their lowest point in more than a decade. Although more properties are entering the market, their prices remain unattainable for most potential buyers. This sets the stage for a significant and swift decline in residential property prices. For generations, owning a home has symbolized a cornerstone of the American dream, offering both the security of having a place to live and a substantial investment in the future. Unfortunately, the latest data suggests that the real estate landscape in the United States is undergoing a tumultuous shift for the worse. Indeed, in recent months, numerous economists have been sounding the alarm that the American economy might be on the brink of another housing recession. Their concerns intensify as housing prices undergo significant fluctuations, creating an atmosphere of uncertainty and concern for everyone involved in the market. The combination of a slowdown in economic activity, a swift surge in housing supply, and elevated mortgage rates is poised to have extensive repercussions for the real estate sector. In the months ahead, these factors are expected to profoundly impact homeowners, investors, financial institutions, and builders alike. the industry faces a challenging period with potential far-reaching consequences. As the real estate market faces challenges, real estate investors may witness a decline in the value of their investments, and financial institutions could encounter risks associated with mortgage defaults. However, the brunt of the impact is likely to be felt by homeowners who are at risk of experiencing a painful loss of home equity. This not only makes it more challenging to sell their properties, but could also contribute to an unprecedented surge in foreclosures. The bubble that formed over the past few years led to a remarkable 46% increase in the median home sales price. From $329,000 in the first quarter of 2020, it soared to $495,000 in the fourth quarter of 2022. This rapid surge marked one of the fastest rates of median home sales price increases in the history of the United States. The consequences of this sharp rise in home prices are now unfolding, with potential distress for both homeowners and the broader real estate market. To provide some perspective, from 1998 to 2020, the median home sales price experienced a substantial 46% increase. However, the current situation paints a different picture, with property prices now significantly overvalued, meaning they surpass their fundamental value based on factors such as rental income and affordability. The main culprits behind this overvaluation are speculative buying and excessive lending during the pandemic. Investors, enticed by the prospect of quick profits, fueled the housing bubble, driving prices to unsustainable levels over the last 3 years. Now, as the market shows signs of freezing, these investors are realizing that quick profits are no longer a guarantee. Consequently, many are rushing to exit before a major burst occurs. This rush to sell has contributed to the considerable decline in median home sales prices, reaching almost $660,000 in 2023. Presently, the average home is selling for $431,000, down $59,000 from December 2022. The market is undergoing a significant correction after the rapid inflation seen in recent years. Economic indicators, including high unemployment rates, diminished consumer confidence, and reduced growth, are likely to worsen existing demand issues, pushing property prices toward a correction. The credit crunch can play a significant role, as higher borrowing costs may further impede the affordability of homes. When access to credit tightens, it can affect the pool of potential buyers and slow down property sales. Moreover, global economic events, such as ongoing geopolitical conflicts, China's economic downturn, and global food shortages, have the potential to spill over into local property markets, impacting investor sentiment and confidence. The convergence of these factors creates a precarious environment that heightens the risk of a significant downturn in the real estate market. The impending housing crash is poised to erode the wealth that many hardworking families painstakingly built over decades, and witnessing this slow-motion train wreck is undeniably disheartening. What adds to the distress is the realization that both the Federal Reserve and the federal government seem poised to let it unfold. The suggestion that taking the equity of the bottom 90% of Americans is a potential solution raises concerns. It implies a desperate measure to offset the economic fallout caused by the massive injection of trillions of dollars into the economy since 2020. This situation is indeed a man-made disaster, and the narrative suggests a grim outlook, that the loss of hard-earned assets might be a sacrifice deemed necessary to curb the inflation resulting from economic interventions. As we navigate these turbulent times in the real estate market, it's crucial to stay informed and engaged. The impact of the impending housing crisis is a collective concern, and understanding its nuances is key. We appreciate your time spent with us today, and we encourage you to share your thoughts in the comments below. Stay tuned for more updates, and together, let's navigate these challenges with knowledge and resilience.